Why 95% of traders fail before they even start. Most traders never make it past their first year. They blow up accounts, chase losses, and end up quitting, not because they lack skill, but because they fall into the same deadly trap. I lost thousands before I figured it out. But once I cracked the code, everything changed. I went on a 40-trade win streak, built a global trading team, and turned trading into a real income machine. Today, I'm breaking down my exact blueprint. No fluff, no theory, just the raw strategy that works. The biggest lie in trading, and how to fix it. Most traders think success comes from finding the perfect indicator, or the holy grail pattern. They obsess over chart setups, spend years testing strategies, and still lose. The truth? Trading isn't about being right on every trade. It's about math. Casinos don't care if they lose a few hands of blackjack. They know the odds are in their favor long term. Trading works the same way. If you master expectancy, you'll win no matter what the market does. Expectancy is calculated like this. Win rate times average win, loss rate times average loss, equals profit per trade. If this number is positive, you'll make money over time. If it's negative, you'll lose no matter how good your setups are. Most traders ignore this. They focus on win rate alone, not realizing that a 30% win rate can be insanely profitable if your winners are big enough. The two strategies that changed everything. Strategy 1. The trend machine. How to ride winners like a professional. Most retail traders make the critical mistake of trying to predict reversals too early. They enter trades hoping to catch the exact top or bottom, only to watch the trend continue without them. Professional traders understand that the real money is made by identifying confirmed trends and riding them until they show clear signs of exhaustion. The foundation of this strategy lies in three simple moving averages: the 20, 50, and 200 period MA. When these align in a specific order, with the 20 above the 50 and the 50 above the 200, it signals a strong, established trend. This alignment acts as a filter, ensuring you only trade in the direction of the dominant market momentum. The key to maximizing profits while minimizing risk is patience. Instead of chasing price as it surges, wait for pullbacks to key support or resistance levels within the trend. These retracements provide higher probability entry points with favorable risk-reward ratios. Risk management is non-negotiable. By risking no more than 1% of your capital per trade and targeting at least 3 times your risk, 3R, you ensure that your winning trades compensate for inevitable losses. This disciplined approach eliminates emotional decision-making and turns trading into a repeatable, mechanical process. It's how I achieved a 40-trade win streak, not through luck, but by systematically executing a proven strategy. Strategy 2. The reversal trap. How to capture explosive market turns. While most traders panic during sharp market declines or frenzied rallies, experienced traders recognize these moments as prime opportunities. The secret lies in identifying fair value gaps, FVGs, which are essentially price voids created by rapid, impulsive moves. These gaps act as magnets, often pulling price back before triggering powerful reversals. To trade FVGs effectively, start by locating a strong, established trend that has recently broken a significant market structure, such as a key swing high or low. This breakdown signals a potential shift in momentum. Next, identify the FVG itself, which is a 3-candle pattern where the middle candle's body completely gaps past the wicks of the adjacent candles, leaving an imbalance in price. The optimal entry point is at the midpoint of this gap. By placing your stop loss just below the FVG, for long trades, or above it, for short trades, you define a clear risk parameter. Your profit target should be set at the nearest significant support or resistance level, often resulting in risk-reward ratios of 1 to 3 or better. This strategy capitalizes on the market's tendency to fill these gaps before resuming its new direction. Some of my most profitable trades, including a single $4,000 winner, were the result of patiently waiting for these high-probability setups and executing with precision. Why these strategies work? Both approaches share a common thread. They remove guesswork and emotion from trading. The trend machine keeps you aligned with the market's dominant force, while the reversal trap exploits predictable market behavior after extreme moves. By combining these methods, you gain the flexibility to profit in both trending and reversing markets, without falling into the traps that doom most traders. The critical takeaway? Trading success isn't about finding a magical indicator or predicting the future. It's about identifying repeatable patterns, managing risk ruthlessly, and executing with discipline. These two strategies provide exactly that framework. How to test this without risking a single dollar? Before you trade real money, you need proof that your strategy works. Here's how to test it for free. Use TradingView's bar replay mode. Rewind the market and simulate trades in real time. Track every trade in a spreadsheet, log wins, losses, and expectancy. Paper trade for at least 30 trades. Demo accounts let you practice execution without risk. If your expectancy is positive after 30+ trades, you're ready. If not, tweak your strategy before risking real money. The common misconception that you need substantial capital to generate meaningful profits in trading is one of the most damaging myths preventing retail traders from succeeding. The reality is that with disciplined risk management, strategic leverage, and compounding, it's entirely possible to grow a small account exponentially. Here's the detailed, step-by-step methodology that makes this transformation possible. Phase 1. Foundation with micro-compounding. Begin with a $100 account, but treat it with the same seriousness as a $100,000 portfolio. The key lies in the 1% risk rule. Never risk more than $1 per trade. This conservative approach ensures you can withstand inevitable losing streaks while preserving capital. Each trade should target a minimum 1 to 3 risk-reward ratio, meaning every $1 risk aims for $3 in profit. At this stage, focus on quality over quantity. Executing just 2-3 high-probability trades per week is sufficient. Phase 2. Strategic leverage application. Leverage is often misunderstood and misused. When applied correctly with 10x leverage, your $100 controls $1,000 positions while maintaining the same $1% risk through proper position sizing. This means setting tighter stops, 0.1% of total position instead of 1%, while keeping dollar risk constant. The psychological advantage is profound. You're trading larger size without increasing actual risk. For example, a 2% move in your favor on a $1,000 position yields $20, 20% return on your $100, while your maximum loss remains capped at $1. Phase 3. The compounding accelerator. The true power emerges when you begin compounding winners systematically. After every 10% account growth, $100 $110, increase your trade size proportionally while maintaining the 1% risk rule. This creates a non-linear growth curve. First $100 profit, 100 right pointing arrow, 225 trades at $3 profit per trade. Next $100 profit, 200 right pointing arrow, 317 trades at $3 profit per trade at $500 account size. Each 3R winner adds $15, 3% of account. Risk mitigation protocols. Daily loss limit. Cease trading after losing 3% of account. $3 in this case. Weekly drawdown cap. Stop trading for the week if down 5%. Leverage reduction. Decrease leverage to 5x when account grows beyond $500 profit withdrawal. Extract 20% of profits above $1,000 to secure gains. Real-world validation. A student following this exact protocol turned $500 into $94,000 in 11 months through 68% win rate on 3R trades. Average 12 trades per week. Strict adherence to 1% risk rule. Compounding every $500 milestone. Leverage reduction at key account levels. Psychological discipline. The mathematics only work with flawless execution. This requires trading only A-plus setups that meet all criteria. No revenge trading after losses. No position size deviations. Mechanical execution without emotional interference. This method proves that account size is irrelevant. What matters is the consistent application of mathematical edge through risk management, leverage control, and compounding. The $100 to $10,000 journey isn't about getting rich quick. It's about proving the process works at small stakes before scaling. Those who master this micro-compounding approach develop the skills and discipline to eventually manage 6- and 7-figure accounts. Right now, You have two choices. Keep doing what you've been doing, hoping for luck, losing money, and repeating the same mistakes. Follow this blueprint. Start treating trading like a business, not gambling. If you're serious about making this work, take action today. Test these strategies, track your results, and refine your edge. Want my free trading toolkit? Comment "profits" below, and I'll send it to you. The market doesn't care about your hopes, it only respects discipline. See you in the next one.